this video we're going to have a look at the time lag that often occurs when the RBA implement either a tightening or loosening of monetary policy, and also some key indicators the RBA will look at when determining their monetary policy stance. So first of all, when the RBA decide to increase or decrease interest rates through the cash rate, it can have a time lag of up to 2 years before it has its impact on economic activity and inflation. So what I mean by that is, when the RBA decide to increase the target cash rate, that's the first thing they will do. And that they will announce it on the Tuesday of the month. Then what has to happen is that target cash rate has to flow on to other interest rates within the economy, which can take some time before the banks pass on the full rate cut. Then there's kind of a third process where the level of construction investment starts to reduce because we've increased the cash rate. So they've increased the target cash rate. It's taken time to flow on to other interest rates. Then businesses start to reduce their construction because their borrowing costs are higher. That leads to less demand for labour because they don't need as many workers because they're not investing as much. Then because those workers don't have as much income because they've been sacked, they start to reduce their spending, and that flows on to less consumption spending throughout the economy as well. But that process from lowering the cash rate to other interest rates falling to construction investment falling and then demand for labour falling, their incomes reducing, and then the flow-on effects to consumption expenditure can have a long-term impact of up to 2 years. And for that reason, the RBA has to be quite preemptive, and basically they have to predict inflationary pressures in the next couple of years before deciding on their stance. So the RBA is likely to look at a whole range of indicators to determine their target cash rate and act in a very preemptive manner to ensure that they do their best to dampen inflationary pressures before they occur in the economy. So they're going to be looking at a whole range of leading indicators to try and determine the inflation in the future because they're essentially predicting with their stance what's going to happen. So because time lags slow down the transmission mechanisms, the RBA has to therefore stop inflation before it occurs and be forward-looking. They will often look to leading indicators to determine what's likely to happen to inflation in the future. So some examples of leading indicators, and I'll just go to the next slide because it explains them a little bit clearly. These are things that basically are better indicators of what's likely to happen to the future level of economic growth. So when consumer confidence and business confidence is high, or there's a lot of loan approvals, so a lot of people are getting mortgages for their loans, that's a sign that there's going to be a lot of growth in the future, because high consumer confidence, for example, is likely to lead to future spending by consumers, business confidence, increased investment spending. Other leading indicators, building approvals, because that will give you the idea of the amount of construction that's going to occur, and therefore the labour and wages will flow on from that. Retail sales levels, so if they're high, it's a good sign that there'll be future growth in the future as well. And then we've also got lagging indicators, which basically give us an indication of what's happened in the economy in the last few months. So they're not as forward-looking. The RBA will still use them, but they're not as effective. So that includes unemployment rates, inflation, income and wages, the terms of trade, the exchange rate. They're generally telling us what's happened in the economy in the past, and they're less of an indication of what's likely to happen in the future than leading indicators. So some of the best indicators of inflationary pressure are all of these things. So the RBA will look at all of these things before determining whether to increase interest rates or tightening or loosen interest rates. So for example, some examples of things that would lead to a tightening of monetary policy: if there was more loan approvals, if credit growth was increasing, so consumers were going into more debt, they would use a tightening to slow down the level of spending in the economy. If there were more building approvals, that's probably a sign that there's a strong level of economic growth. If job vacancy rates increase, that's a sign there's a lot of demand for labour because there's a lot of ads going out in the papers, so that's another sign that they would be likely to implement a more expansionary stance, a more contractionary stance and slow down the rate of growth. If there's strong growth rates overseas, they're going to have to tighten monetary policy because that's going to create more growth in Australia. Wage growth will cause inflation. If the exchange rate depreciates, that can cause inflation. If we have a high terms of trade, that can cause more income for miners and therefore more consumption and inflation. When business and consumer confidence is high, or share market prices are high, or property prices are increasing, all of these things are likely to lead to increased inflationary pressures in the future. On the flip side, if the economy is experiencing weak wage growth, a high exchange rate, a low terms of trade, reduced debt levels, slowing property prices, a lot of spare capacity in the labour market, they will all lead to more of a loosening of monetary policy. So, loosening monetary policy, once inflation is under control, the RBA will tend to loosen monetary policy to help employment and growth in the short term. But the thing you need to be aware of is that loosening monetary policy, while it helps growth in the short term because it stimulates spending through all the channels, it can lead to inflation, and therefore the RBA have to be careful that by loosening monetary policy, they're not going to hurt future growth rates by causing inflation to increase because of the increase in spending. One other thing related to this part of the course is that the RBA, they don't actually have to physically change the cash rate to have the impact that they want to. Often by just announcing that they're going to increase or decrease the cash rate, it can have the impact on spending that they want. So for example, if the RBA were to hint that they were going to increase interest rates, that's likely to lead to banks increasing their interest rates. And what consumers are going to do is they're going to start to slow down their spending because they think that interest rates are going to increase, and if they get out a loan, they're going to be paying more on that. Or on the flip side, if they save more, they're going to be getting a good return. So what happens is if the RBA comes out and it announces a higher interest rates, it can slow down consumption spending. Employees are less likely to demand a higher wage because they know that inflation is going to be under control. Firms might start to hold off investment spending because they know that they're going to be experiencing high borrowing costs in the future if they go into debt. So all of these things will happen just by the RBA announcing that they're going to raise the cash rate. It will slow consumption spending, it will slow investment spending, it will reduce the workers demanding a higher wage and have some positive impacts on slowing down the level of inflation. Also, because the RBA act in a preemptive manner, they can often get it wrong. And what I mean by that is the RBA can often predict inflation is going to occur, and then what happens is like there's a natural disaster, a GFC or some sort of economic event that actually slows the economy down. So, for example, in 2008, the RBA raised interest rates to try and slow the economy down because we were experiencing high inflation. Then what happened is the GFC hit, and the RBA had high interest rates, and therefore what was happening was the interest rates were working to slow the economy down even further. So they were actually working in a pro-cyclical manner, which basically meant they were making the trough even bigger. Likewise, the RBA the RBA can also get it wrong the other way, where they anticipate we're going to enter a trough, so they lower interest rates, then we enter a boom, and that can lead to, again, an even bigger boom because we have low interest rates. So being preemptive can also mean that the government get it wrong, and it can also mean that the RBA also may decrease interest rates even if we are experiencing inflation. So an economy might be experiencing 5% inflation, and the RBA will still potentially decrease interest rates if they feel inflation is going to be really low or growth is going to be really low in the future. Because it's preemptive looking, they may still decrease interest rates even if we're above our target range. And they may still increase interest rates even if inflation is only at 1%, if they feel that it's going to be inflationary pressures in the future.